Welcome to this Look Ahead 2025 Market Town Hall. While we've been talking to public market investors all the time, what we're doing now is speaking to two top private market investors. This is a space which has really exploded over the last couple of years, both in terms of new deals and big exits as well. I'm Prashant. With me, my colleague Mangalam. Mangalam, hi.
Hi, what an incredible lineup that we have today. We're joined by Norwest partners Niren, Shah and Gaja Capital's Gopal, Jain. Between them, these firms manage nearly $16 billion in assets under management. While Niren is focused on late-stage venture to early private equity space, Gopal is growth-focused and operates in the mid-market segment. So between the two of them, we have the entire supply chain or the entire chain of VC and PE.
Oh, absolutely. And I think they've been at it a long time, and they've got some really big winners under their belt. So, gentlemen, thank you very much, both of you, for joining us. I want to start with a slightly top-downish kind of approach because you guys can afford to do that, right? You're not tied to the benchmark and sort of, have to answer to investors, but not every month or every quarter. Niren, in your sort of career, and I'll come to you, Gopal, as well, we're in a bit of a slow, soft growth patch, right? We're in the growth is in the 5% handle. It's made no difference to public markets, at least. Does it make a difference? Has it made a difference? Because we've encountered these slow patches earlier as well. Just what's your sense, and what's the outlook looking like for India and investing?
So I think that, no, it does not make a difference, these slow growth patches. We're really looking at sort of 8-10 year horizon. And if you look at the global sort of macro, I think India is in a sweet spot. I often say this, that if you were to be in India and to be in business and investing, this is the best 20 years you're going to get, going back 100 years and going forward 100 years. Wow. So as Norwest, we're very bullish about the sort of country where we are and the kind of growth we're going to witness. I think you will have, for every 3 steps forward, you may have half a step back. And that's part of the parcel. But I think if you just stay focused on the next 15 years, I think India has a great story coming.
What about you?
So from the time I started investing 1991, India was a $300 billion economy. And despite the 3 steps forward and 1 step back, it's grown from 300 billion to 3.5 trillion. And we can talk about whether it's going to take 5 years or 7 years or 10 years, but we are going to become a $10 trillion economy, say in 10 years. So in the next 10 years, this economy will create more value than what has been created in the last thousands of years.
Right.
What a phenomenal opportunity. Right? Look at the Sensex. The Sensex was what? At its peak 30 years ago. It's gone to 80,000. Compounding is the 8th wonder of the world. Investors cannot constantly trade in and trade out. You have to lock into secular trends and ride them. And one of the best secular trends in the world currently and for the past many years has been India.
Okay. Niren, let's dive. I think our audience, we've got a great audience set of students here from across colleges in Mumbai.
Hi, guys.
And of course, our audience who's watching us on TV also wants to know themes, right? Which, as they say, fish where the fish are. So we're going to ask you where the fish are. Niren, quick commerce is what I want to start with, and I think you should have expected that question. Yeah. For those of you who don't know, Niren and Norwest were one of the early investors in Swiggy, and I think they invested at a $30-35 million valuation. Swiggy, of course, is now a $16 billion company, so it's been a huge winner for you. So let's start with that space. You're still bullish on the space.
Very bullish on the overall space, and of course, a big thanks to the Swiggy management for innovating on this space. So I think for us, according to me, it's very rare that you see in a country of India's size that a particular market is compounding at 100%. So one of our predictions for the next year in 2025 is that the quick commerce space in general will grow at about more than 100%. And I think that's completely driven by the fact that Indian consumers, if you just look at your own spending patterns, you want some of the deliveries now. You're noticing more and more that you need it much faster. And it is taking a little bit of share away from e-commerce. So to that extent, we think that will be one of the top themes of something growing at 100% plus in the next year.
I think the joined at the hip question is, are valuations too expensive? I think Mangalam does that in terms of FMCG valuations, consumer valuations all the time. Just your thoughts.
So I think that when something is growing at 100% and looks like it might compound at 100% for a few years, I don't think
pay up.
The valuations are actually quite cheap then.
So valuations is one part. The other part is that while this is a big growth opportunity, there are a lot of people who are entering this space as well. I just want to understand, 3-4 years down the line, what does the industry look like? Do you have two large players and some strong regional players, or what happens to quick commerce is the same thing that happened to food delivery, where only two people remain? How does it work?
So we've gone through this many times over,
Yes.
especially in network effect businesses like, e-com, quick com, some of these things. I think that the big will get bigger.
Okay.
And I think that multiple people will try. But at the end of the day, I think once you've got a certain size and moat, I think it's hard to disrupt that.
The reason why I ask you that is because you're invested in Swiggy, in the quick commerce scheme of things, they may not necessarily be the biggest, right? So you have Blinkit, you have Zepto, which is raising a fair amount of funds, etc. So in light of that, how do you look at maybe something like a Swiggy?
So, I mean, look, honestly, I would say Swiggy offers both food delivery and Instamart on the platform. So if you look at one platform, they are the largest. And in some ways, if you look at the sort of growth, etc., you see the last few quarters, I think that's growing really well. So I think that, the market is just growing at a very large pace. So my 2 cents is going to be eventually more about, 3-4 years later, what is the size of the profit pool, right? And who's going to be able to capture that?
By the way, when you invested, did you think we'd want things in 10 minutes? I mean, actually, that came much later, right?
Much
The
later.
10 minutes. It was not the business model.
Well, when we invested, we thought that, we were like hoping and praying that this would become like $1 billion company. That was like our outcome. And that was our best case.
Wow.
And of course, the rest is history.
Gopal, you want to add to that, or should we talk about what you like? And what you like is enterprise software, businesses using software across enterprise functions. And when we first spoke about it and you told me that, I said, well, most companies use software, right? Who doesn't use software? And you think that's a mega trend. Just explain that.
Yeah, businesses in India are increasingly using software for enterprise functions. In fact, businesses in India are behind consumers when it comes to using software. You'll see some very large companies still running their payroll on Excel. So, you must have heard software is going to eat the world.
Yeah.
Well, software is starting to eat the business world in India.
Got it.
New age companies, in fact, lead software adoption to run their enterprise functions. But older companies are catching up. So as B2B consumption of software rises, and as SaaS is just a model for software consumption, you're going to see homegrown product companies.
Got it.
That provide enterprise software to large businesses, mid-sized businesses. The trend's going to become more and more powerful. So we believe in backing homegrown product companies get their first $10 million of revenue in India. And some of them have a real shot at becoming large, valuable. We've seen this over and over again. I remember when we were investing in IT services 25 years ago, very few people believed that the world's largest IT services companies would be Indian.
Right.
Today they are, right? So over the next 10 years, you will see some very successful software product companies from India.
So in that
successful
itself,
on a global stage.
For our viewers, I think what you're talking about, to give a name, because something like
Wait, for example, is
or maybe in the listed space, Zaggle, something similar.
something similar,
Okay.
right? Which
Those
is recently there was a SaaS company called Unicommerce that went
Yes.
public. These are companies that are small today. I can't comment on their individual prospects, but these are examples of product companies now starting to go. So far, IT services in India has been services. It will remain services, but the product story will also get added.
So in that itself, if you could tell us, what are the specific white spaces in the products as well, where these companies have a real shot? I mean, what is the biggest opportunity
See,
here?
the big enterprise class software companies exist, but they're often not suited for the Indian context.
Got it.
Right, because where affordability is an issue, there's a higher need for customization, there is a lower tolerance for implementation time. So take the simplest of functions, finance, accounting, payroll, HR, CRM. These are some spaces that are seeing rapid adoption of software by businesses in India.
Yeah.
Can I add to that?
Please.
So I think I would totally agree on the same theme. I think we have three very interesting companies. One is the largest player in the B2B commerce space. It's called Off Business. It does about 800 crores of EBITDA. In the next 2-3 years, at some point of time, it will list on the market. Again, growing very rapidly. So I think a lot of new age companies in this sort of software space, in the whole B2B space, right, they are actually going to do really well. I think B2C, we're already seeing that sort of surge. Now you're going to see that in B2B. We have another very interesting company called Amagi. So Amagi basically has taken broadcast from, just very simply put, from the boxes to the cloud. It's one of the largest companies globally in the sort of SaaS space. And from India, it's doing about $120 million of ARR. We came in quite early. Again, it's become a very large company. And if you look at someone like an Amagi, it's a market leader globally. So I think 80-90% of the business is international. All the top, 500 media companies are all streaming on Amagi now. But very proud that it's from India to the world. So I mean, this is again a very deep tech company because you're streaming sort of millions and millions of streams every moment. You can't go down. And third one is another one we have in the construction SaaS space called Expedion. It's an earlier company, but believe it or not, they're getting $1 million orders in the UK and Saudi and, to just run construction platforms. Large construction companies are running their entire sort of business, accounting, finance, and everything else on something like that. So I think this is a big theme. I think India's time has come, and basically products going outside will be really, really important, not just in India, but also overseas.
And the India for the world is a big theme, even in the D2C space, where a lot of the other companies that are coming out with world-class products now looking to sell in the global time as well. Speaking about themes itself, just a very simple question. Themes, identifying them, how do you do that? That's point number one. And secondly, a lot of your companies are now listing as well. A lot of the people who are looking at listed companies, which are coming from the new businesses or PE-backed companies, etc., how do you, research upon them, and how do you identify whether the metrics are right or not? Because a lot of them are EBITDA loss-making, a lot of them are net profit loss-making, a lot of them don't understand these metrics, but they create a fair amount of wealth. So if you could give us a few hacks, to use a Gen Z term.
Okay, I'll go first. So basically, it's very thesis-driven. You're reading a lot, you're assimilating a lot, and trying to figure out what's coming next. So the idea for us, at least at Norwest, is we're a little contrarian, a little ahead of the curve. If a herd is reached there, we will try not to do that. So we're trying to be a little ahead. In addition to that, I think a lot of it is meeting founders, looking at the data, looking at thesis, meeting a bunch of companies in that space, and being able to determine whether this makes sense. And finally, backing that up to your last question with due diligence, to make sure that what was mentioned to us or spoken to us, or these are the numbers, actually gets validated by accounting firms to make sure that the governance, the numbers, the structure, the risk compliance, etc., is sort of properly checked.
That's when you guys are speaking to them. But when one is reading the red herring prospectus, they don't have the access to the management the way you guys have, right?
But coming back to your earlier question, we use a framework called EIBC. I think there are many students here, economy, industry, business, company. You have to start with a trend, a consumption trend. For example, you could say, well, Indian households are starting to improve their kitchens. That's an economic trend. And then you can drill down further to say, how are these kitchens being improved? There are 300 million households, 350 million households. Let's say 150 million of them are starting to improve their kitchens. Simple trend. And you can drill this down using the EIBC framework to come down to businesses, and within businesses, companies. And how do you go about them? Research and relationships, right? So you got to do your research. You can't just rely on secondary research, so you have to do your primary research and relationships. So research and relationships combined with EIBC can help you come up with companies. Valuations, what's the hack? Well, the best hack over the long term is to stick to fundamentals, right? I mean, it always scares me when I see companies and markets trading on vanity metrics. Let's go back to fundamental. There is no justification for companies to trade on vanity metrics.
What do you mean by that, vanity metrics?
A stock price is purely a function of earnings per share and EPS growth. And the number of years you can see that. The world's largest market, the US market, trades largely on fundamentals.
Yeah.
Right? In fact, what's happened in private markets over the last 3 or 4 years is that fundamentals have come back to fore. Now, when people say markets are driven by technicals, it means markets can't be justified on the basis of fundamentals.
Absolutely.
Right? So your vanity metrics come in, your revenues come in, right? When people fail to make a distinction between, are these operating profits or treasury profits. And remember what the great Buffett said, the tide does run out. And then, I mean, it ran out in September 21 when technology companies lost so much of their valuation. And which companies lost their valuations? The companies that were trading on vanity metrics. So the way you should do this is look at your portfolio. You may decide to allocate some of your capital to companies trading on vanity metrics because they have phenomenal potential. And at some point of time, they'll develop the right fundamentals. But you have to carefully control that number. You have to carefully monitor that number because riding vanity metrics is like riding a tiger.
Absolutely. And time does run out on those, right? I mean, eventually. That's a solid advice from both of you. Let's get back to themes. By the way, the three companies you mentioned, all listing soon? All coming to the market soon?
Yeah, all will come to the market in the next 2 years, in 2.5 years.
You have 7 of them likely in the next 2 to 3 years, right?
Yeah, we have actually about, I think if we were predicting, I would say about 10 companies should be filing to go public in the next 2 to 2.5 years.
What would they be if you may?
There are a bunch of them. So there's a company called, SK, which is already filed. It's the largest unlisted sort of CV, and it's a financial services company, very strong sort of management. We've got another one called Veritas, which is an MSME finance company. We've got one called Mintify, which is one of the largest supply chain fintechs in India. I mentioned off business, so I won't repeat that. We've got another housing finance company. We've got healthcare RCM company. So we've got like a hospital. So I think a bunch of
lot of sales coming. Theme, one more theme, Niren. What is the big from here? I mean, because
So I really think that it's time for industrials, right? So I think that in India, sort of India to the world, and manufacturing with this government sort of push, industrials, aerospace, autocom, those things it's time to shine. I'm actually less bullish on the commodity spaces, but much more bullish on some of these where there is an engineering component. I think that with China sort of waning a bit, India is getting to the size and scale. And I think that for the next 15, 20 years, we have that engineering talent where we could actually be, exporting this and doing much better. And I think we're taking more and more share from places like Mexico. So we are continuing to look at, autocom, aerospace, those kind of deals and those kind of sort of investments right now, which we think is sort of going to be the next big thing coming out of India.
Anything that you own in your portfolio?
Right now, no. We're actually looking at a couple of companies, so hopefully we'll have something to show for that in the next few quarters. But definitely a theme which we think can be very large.
I mean, in the public markets, huge amount of interest in some of these spaces. Gopal, you did talk about that kitchen theme, improving spending on kitchen. That is emergence of
you could take a step back and say the economy level trend is the emergence of discretionary spending.
Yes.
And youngsters have seen discretionary spending and Niren's a few years younger than I am, but I've seen India when there was largely non-discretionary spending. And at $2,000 per capita, that's the point. Inflection is a much misused word, but let's use that word. $2,000 per capita is the point of inflection where a disproportionate amount of spending goes towards discretionary items, right? You have a kitchen, you want to make it better. Make it better is discretionary spending, right? You can go to an Indian university or you can go abroad. That's discretionary spending. Well, there are government schools that don't charge any fee, but you choose to send your ward to a private fee-charging school. That's discretionary spending. So we are seeing now discretionary spending, and as India goes from 3 trillion to 10 trillion, there's going to be a disproportionate amount of discretionary spending, and this discretionary spending will create a tremendous amount of value. Which breed of companies.
Narrow it down a little bit, Gopal.
So we can talk about education, for example, financialization. These are two direct manifestations of discretionary spending. Take education. We've invested in a business which is an online marketplace for accommodation, student accommodation.
Okay.
So India now, along with China, sends a very large number of students abroad. This is a typical trend that you see as developing countries grow. They realize that they don't have enough higher education capacity, not enough IITs enough. So on the back of that, there's a business that's created that actually caters to over 50 countries, students from 50 countries, and offers housing. It's a virtual business out of Pune. And that's an example of a business, 100% dollar revenue business, that's being built on the back of discretionary spending.
You're also an investor in, I mean, that's one segment. You said financialization, I think. You've been in long-time investor in RBL Bank, and I think
So
it's straightforward lending. So
RBL Bank, if you remember, we were anchor investors in 2010. Then we again played anchor investor in 2020. It's an example of financialization, savings, and I would say that's sort of non-discretionary.
Yeah.
But discretionary is an example of that is asset management and wealth management businesses. So something like Avendus,
Right.
which has grown on the back of wealth management, right? So there is growing wealth, and wealth management as a service is part of discretionary. So that's an example of how discretionary spending plays its role.
Speak about the
growth of mutual funds. And sorry.
No, you speak about the education sector, lending, etc. And he also said, you have to know when to get off the tiger. He's been pretty good at getting off the tiger without getting bitten. But, let's circle back to the discretionary part of it itself. We started speaking about quick commerce. We spoke about Swiggy. Were you tempted to look at any of these spaces when it comes to discretionary spending? Because kitchen is one part. Now, increasingly, people are thinking that maybe we're in
an
a
example.
just-in-time kitchen sort of thing.
As an investor that's invested for 30 years on the back of fundamentals, we've played e-commerce through the ancillary space. So both Niren and I have an investment in a company called ExpressBees.
Okay.
Right there, the business was closer to fundamentals. So yes, we weren't as smart as Niren. We weren't able to get over the line.
By the way,
when it came to some of these e-commerce businesses and quick commerce businesses. And that's going to be our style. Our style as a growth stage investor, because we come in later, we look for a certain unit economics, a certain path to profitability. The great Buffett has made less than 100 investments in a 60-year career. And that is the Gaja capital. That's the model we are looking to emulate. We've made in 25 years as many investments as many VCs make in a single year. So we carefully choose our shots.
No, absolutely. And you're being humble, and you can't get them all. So I think that's the way I would look at it. But are valuations expensive? I mean, that's a question we ask in public markets all the time. And by the way, you guys are competing with public market investors now.
Yeah.
Who are all turning VC because they're going back and back, pre-IPO, pre-IPO, because by the time it gets to the market, it's all juiced out.
Everyone just wants to go to before the starting line as well. Everyone just wants to...
So let me rephrase that. They're competing with us.
Okay.
They're doing what we were doing.
They're competing
with us. So So I actually think that market valuations are quite high. Yeah. And I think that's driven by the public markets. So you have to space out your investments and stick very close to fundamentals, as Gopal mentioned. Because I think that, when you sort of focus on non-fundamental driven or, very poor unit economics or things like that, eventually, in a lot of I would say, late-stage venture side, you find that the unit economics are just not working out. Yeah. So I've at least felt that we focused a lot on places where your break-even are profitable. Out of our 30 companies, about 26 would now be profitable. Once we come in, we sort of make sure the company gets profitable very quickly. Then we spend a couple of years preparing them for an IPO. Because in India, let's face it, exit has to be IPO.
Yeah.
Right? There's not that much of M&A. And then we help them get to a margin, because you can't just go public at break-even. So you want to get to a margin. And then, believe it or not, it takes you 3 years to exit. You're not going to be able to sell on day one, and you should not want to, because that would really hurt the stock price. So in most of these cases, a lot of private equity investors like us will just say that, look, let's wait over time and exit. So if you add up that journey, that's already 7 years, right? And so I think that it's really important to come in at the right point and to make sure that the risk-reward trade-off makes sense. Valuations are definitely very high. So we are struggling in terms of paying the very lofty valuations, which is coming a little bit, the wind is blowing from the public markets onto the private markets. And obviously you have to be very careful.
It's a gust of wind, strong gust of wind.
Very, very strong gust.
Tornado. I don't know. Gopal, very quickly.
Public markets in India haven't been cheap after 2006, 2007. And may I say, they are unlikely to ever become cheap again. Right? So what you have since 2006, 2007, you have short temporary periods of correction, 2008, 2013, 2020, in which technicals catch up with fundamentals. But the markets have consistently stayed a year to 2 years ahead of fundamentals. Currently, markets are looking a little more expensive than they did because the trajectory of earnings has shifted. We were all expecting sort of an 18% trajectory to earnings, and currently it's looking like 14, 15%. Hopefully this gets ironed out. But given the long-term prospects in India, it's easy to see why Indians are so optimistic about the future. why they are here to 2
I hope
years.
all Indians are optimistic, not just investors. Because I think that will make all the difference.
Well, you know, the number of depository accounts has gone from 6 crores
Yeah, exactly.
to 17 crores in the last 5 years.
Absolutely.
So an increasing number of Indians have their savings invested in equities, either directly through shares or mutual funds.
Gopal and Niren, thank you very much for coming in. We'll close the conversation here, but very interesting insights. And I hope for our audience here in the studios, and of course those who are watching, light bulbs and neurons all connect, and they're able to figure out ideas. And you've laid out the big themes, and you've got to look within those themes to find bets.
And as they say in PE, this is the first conversation. This is a promise of many more conversations, a lot deeper conversations that we have on our channel.
Absolutely. Well,
Having us.
Thank you
so
very much once again. Well, it's a wrap from all of us here on this special Market Town Hall. It's a VCP special, and as Mangalam said, many more in the future. Thanks for watching.